Welcome to the show Retire Right by Outlook Money. This episode is in association with HDFC Pension Management Company Limited along with Outlook Money. I'm Nidhi Sinha, editor Outlook Money, and today's topic of discussion is the two stages of retirement planning. We have with us Mr. Sriram Iyer, who's the Chief Executive Officer of HDFC Pension Management Company Limited, and he'll talk about this new topic today. In the previous episodes, we have talked about the need for retirement planning and the barrier in terms of the demographics, individual attitudes, and so on. We've also talked about how to build a retirement corpus that can sustain us through our lifetime. But we also need to realize that retirement planning is two-pronged, and there are two phases in the process. The accumulation phase, where you basically invest and prepare for retirement, and the deployment phase, which comes after you retire, and you're required to divvy up your corpus to provide for your retired life. So let's delve deeper into this topic with Mr. Iyer. Welcome, Mr. Iyer.
Thank you.
Starting with the first question, and I'll keep it very simple for the viewers. If you could elaborate on what are the two stages of retirement planning, which I mentioned earlier, and why is it important to plan for both and not just concentrate on one?
So I think, as you rightly pointed out, there is a phase of life when one is generating income, right? And when one is generating income, it is prudent for you to keep aside some portion of that income for a rainy day, which is what you call a retirement, and not just a rainy day. Rainy day could be an emergency as well, but keeping aside a certain portion of your income towards a time in your life when you may not have the capability to earn income. Your income stream may come to an end because you may choose to retire, or it may have come to an end because of, if you're a self-employed person, you may have chosen to stop doing, actively, running a business, or in the case of a salaried person, it could be on superannuation. So there is only a certain finite amount of time that is available to you for you to generate income, right? Which is what is referred to as the accumulation phase, right? And during the accumulation phase, as we spoke about earlier, we spoke about the need for you to start early, need for you to have the right asset allocation, and so on and so forth. That is referred to as the accumulation phase when it comes to retirement planning, right? Now, this accumulation phase also will go through, there will be various phases within the accumulation phase, because there will be times when you may be able to take a much higher degree of risk. As one approaches the milestone of retirement, you may want to pare down the risk in your portfolio, because that will help you make sure that the corpus that you have towards the fag end of your working life is relatively insulated from any volatility that may happen at that point of time. And those are all things that can happen because we saw 2008 happening. So those retirees who didn't protect their portfolio sufficiently by having larger allocations to fixed income vehicles at that point of time, so a significant drawdown in their portfolio, significant losses in their portfolio, and it's very difficult to recoup those losses, especially when one's income stream have come to an end, right? Your ability to generate cash flow has come to an end, or it has maybe compromised significantly on account of various factors, right? So that is the accumulation phase. So you need to make sure that so this accumulation phase is when you start putting money aside. And within this accumulation phase, you also need to decide at what point of time during this accumulation phase what is the mix of asset allocation that you would want, or what is the mix of assets that you would want over the course of this accumulation phase. That's the accumulation phase, right? Which is when you're building the corpus, right? Once you've built a corpus, there could be, and you hit the superannuation age or the age when you say that that's about it. I'm going to hang up my boots. I'm going to enjoy my life now because I've created a certain corpus, or, I've hit a certain age and this was my dream to really retire into sunset. Once you get to that age, you need to start deploying the money that you have put aside and you've built over a period of time in a sensible manner, right? Because keep in mind that your active income stream is going to come to an end, right? Which means that this portfolio will have to be able to sustain your lifestyle, possibly for a period of time longer that you've worked, right? Because you see enough examples of individuals who are now living well past 90, right? And if one is retiring at the age of 60, and you started working at the age of, let's say, 25, 26, which is typically when most people end up starting to work, maybe slightly earlier. You work for 30, 35 years, you're going to live for another 30 years, right? Therefore, at that stage, it is important for you to make adequate changes in your portfolio such that it is able to not just, so you need certainty of income, because you have a certain level of expense that you would want to incur. You would want a certain lifestyle. You may have certain plans to go overseas on a holiday every second year, every third year, every year, depending upon what your aspirations are. You may want to take up a hobby. You may want to do certain things which will cost you money, right? So making sure that this portfolio is adequately, making sure that it is adequate is a function of the accumulation phase. Making sure that it lasts your lifetime is a function of how you manage this and allocate this portfolio post your retirement, right? And therefore, both of these phases are equally important. Accumulation phase requires you to take a elevated level of risk because you're going to have 25, 30 years to accumulate and create this corpus. And the consumption phase requires you to obviously take some risk because you are going to be faced with inflation, and that inflation is going to sort of make the purchasing power of this money lower and lower over a period of time. And therefore, it is important for you to have the right kind of asset allocation so that it not just lasts for a reasonable amount of time, but there is some certainty of income that is there along the way because your paycheck has come to an end, so to say, right? So those are the two, and I hope I've been able to explain both these phases, with adequate clarity.
Absolutely, you have. So you touched upon the importance of asset allocation during your answer, but typically people think about this aspect during the accumulation phase and ensure that the portfolio is diversified and so on. But when it comes to the consumption phase, people largely believe that one should stay in safe instruments. But at the same time, asset allocation is required even in the consumption stage. So, is there an ideal ratio for seniors because it will be different from the accumulation phase?
Well, I think it's and we spoke about personal finance being very personal, right? So I'm not going to give you a stock answer on what is the ideal ratio, but I will try and, shine the light on a few things that are important for us to keep in mind while we build a consumption portfolio. Now, if you look at the variety of financial products that are available, I think there are financial products that are available which can actually guarantee you a lifetime income at a fixed rate, right? And I'm referring to annuities here, right? And and surprisingly, the awareness around annuity as a financial product is actually quite poor in India, and even amongst financial advisors that I've spoken to, there is a fair bit of confusion, or there's a fair bit of lack of clarity on what an annuity does, right? So there are various kinds of products that are available that may be suitable for your consumption phase. One of them being annuity. I just give the example of annuity because I think the annuity, the awareness around annuity as a product where the perception is that the rates there are very low. Let's take the example of NPS annuity, which is a vehicle that I'm familiar with because it's related to the industry that I work in. So the rates on NPS annuities anywhere at the time of retirement, if the person is 60 and the spouse is 55, and if it is a joint life, let's say return of purchase price kind of a plan, the rates are anywhere between 6.5% and 7%, right? Now the immediate pushback is that this rate is very, very low, right? And this rate seems to be much lower than, let's say, a fixed deposit rate that you would get in, let's say, a bank where you have reasonable comfort. But the question really is that, does a fixed deposit help you prevent reinvestment risk? The answer is no, right? Because at the end of 3 years, at the end of 5 years, depending upon the prevailing, interest rate situation at that point of time, the interest rates will get reset. And we spoke about this earlier. As India progresses, as we move towards a developed economy, rates of interest in a long term there will be blips in the medium term, which I can't really talk about. But in the long term, we've seen that the interest rates, fixed income rates tend to come down. In light of which, a product such as this is incredibly powerful, right? 20 years from now, this product, if one has bought it today, will continue to deliver 6.5%. At that point of time, maybe, and this is just crystal ball gazing, please don't hold me to it, maybe the interest rates at that point of time are 2.5%, 3%, right? So when you look at it from that context, it becomes incredibly powerful. The second thing is, If you have a consumption portfolio that you've built over a period of time in your accumulation period, and there is this corpus that is lying with you, you're not going to use all of the portfolio on day one or day two or year one or year two or year three, right? So if you've done the right set of, you've invested in the right set of products, you had the right kind of asset allocation, it will be large enough to be able to take care of your lifetime expenses, right? And you don't need all of it right in the word go. And therefore, you don't necessarily need to lock in everything in fixed income, because keep in mind that whether you are retired or whether you're working, inflation is still going to hit you, right? And like it or not, as one ages, medical costs are going to become a larger part of your expense, right? Typically, a retired individual or an individual who's, crosses the age of 65, 70, out of 100 rupees of expense that gets done, maybe 10 to 15 to 20. And God forbid, there are no emergencies, but even in normal course, you would end up spending 10 to 15 to 20 rupees out of that 100 rupees of expense basket on medical expenses. It's not surprising that medical costs have inflated at the rate of 14 to 16% per annum over the last, and I'm not talking about every procedure, but many procedures that you end up needing as one ages, they inflate at the rate of 14 to 16%, right? So it's something that you cannot hope to be able to service if you do not allocate some portion of your consumption portfolio towards equity-like assets. When I say equity-like assets, there are products that are a combination of equity and fixed income that are available. One must actively consider allocating to those as well, and one must actively consider allocating a certain portion of your money. So therefore, this whole, this thought that, the moment I sort of retire, or the moment I have my income stream has come to an end, I should completely shy away from equity. They can't be a bigger myth, honestly, right? You must have allocation toward these, because inflation is going to hit you 10 years, 15 years, 20 years from now. You'll need a certain portion of your portfolio to grow at double digits. And if you don't need the money in the next 5 years, the same conversation that we had earlier, if you don't need the money for the next 5 to 7 to 10 years, why would you not want to take some level of risk with that money? That could be 10% of your portfolio. It doesn't matter, right? It is worthwhile to consider allocating in equity as well. And therefore, I think it's a balanced approach that will work, and not one end of the spectrum or the other.
Continuing the conversation on asset allocation, you did highlight that it's important to diversify even in the consumption phase, and some amount of equity may be required to do that, depending on, of course, on personal circumstances. But do you think in the accumulation phase, equity should be the mainstay of any retirement portfolio? And I'm not just talking about the younger people or generation, but there is a whole cohort of people who wake up to the need of building a retirement kitty only in their 40s or even later.
Yeah, I think the straightforward answer to that is a yes, right? And the reason why I'm saying this is, of course, it's a function of one's risk appetite. I may be personally okay with seeing my portfolio get drawn down by 20-25% on account of some event that happened, which has caused some kind of a short-term event that has triggered a collapse in the market. I'm comfortable with that, because I know for a fact that my emergency requirements, or the requirements that I have for the next 2 to 3 years, is taken care of. I have planned for it in such a manner that I am not trying to maximize returns there, and therefore I have kept it in vehicles which are safe and which are relatively insulated from short-term market movements, right? I may be built that way, and therefore, I'm okay with any kind of a correction that happens in the market. Not everybody may be okay with that. So the caveat is that it's a function of what is it that you're comfortable with. Having said that, in most cases, my recommendation would be that, as I said, one would, depending upon when you're looking to hang up one's boots, let's say 60 is the age when, most of us say, okay, I'll stop working at the age of 60. There could be some people who may want to do it earlier. But if you've got sufficient time in your hands, right? Equity as an asset class, the risk of equity as an asset class reduces with time, right? And there is empirical evidence to suggest that, right? The risk of volatility in equity goes away with time. If you look at 10-year rolling returns on, let's say, even a passive basket, like a Nifty, right? I mean, you know that, you know the numbers, right? 75% plus of the time it delivers double digit return, right? Probably 85% of the time it delivers upward of 7% per annum kind of a return, right? But these are all probability led. So, 80% of the time that would have happened, but there is 20% of the time that something else could have happened, right? But you need to be comfortable with this uncertainty. But if you're able to make sure that you have created a portfolio where ultimately it's all a combination of the kind of probability of outcomes that can potentially happen over a period of time. In my experience, if you have sufficient time on hands, you have no option but to allocate a meaningful portion of your portfolio towards equity assets, equity vehicles. The vehicles could be take different forms and shape. I'm a big fan of a basket of securities. It could be in the form of NPS, which we'll talk about later, which I think is a absolute must-have for every single individual. We'll talk about that in greater detail. But there are various other vehicles that are available which offer you the ability to participate in equity. Again, they also vary in terms of the amount of the kind of volatility that it may display in the short term and the kind of risk that they may carry. One must choose very carefully and use professional financial advice to understand what are the kind of products that one should choose. It would be very different for a 35-year-old from, vis-a-vis a person who's at 45 or 50, right? So even within equity, the risk levels could be very, very different, right? And therefore, it's important for one to consider that. But definitely, at the accumulation stage, one must not lose the opportunity to compound your money in double digits over long periods of time. It is magical, right? So do not lose this opportunity to create magic with your portfolio by missing out on this opportunity.
Coming to the end of the conversation, I think one of the biggest anxieties or worries retirees have is, will my corpus last a lifetime? So what should they do to ease their anxiety?
I think that's a very, very genuine concern. And frankly, there is no one size fits all kind of an answer to this question, right? I've had the opportunity to meet with individuals who at the age of 55 will say, listen, I'm going to retire in the next 4 to 5 years. What do you think I should do? Frankly, many a times it is way too late, right? So goes back to the point that we made right at the beginning of the earlier episode, where we spoke about the fact that you need to start early, because the lesser amount of time that you have to hit your milestone, or let's say the closer you get to 60, there's only so much that can happen with financial products, right? You can only get lucky. If you're lucky and the market doubles in 1 year, that's a once in a blue moon kind of an event. You're just lucky. But luck and hope is not a strategy, right? So for those individuals who have not created a large enough corpus as one heads towards retirement, the only thing that they can do is reset, their expense lines, even at that stage in life, put aside a larger portion of money towards retirement, right? There is no other option that is available to those individuals, right? And whether you like it or not, I think you will have to relook at some of the lifestyle choices that one has made, and relook at those lifestyle choices and see if it is sustainable, right? The other thing that and which is increasingly getting more and more popular in India is that there are second inning options available to us post 60, because let's face it, at the age of 60 there is enough and more mental and physical sharpness that is still there left in people, right? And therefore, why would you not use that to create an income stream for yourself? So I think if you've not made the right decisions, and if it's, if you're already at 54, 55, 56, and if you just got 3 or 4 years old, 4 years to go for retirement, you have no choice but to keep aside a larger portion of your cash flows towards retirement. Even if it is going to pinch you, you must do it, right? Because don't expect the market to suddenly work wonders for you just because you have slept through your working life, right? I mean, that's asking for too much, right? You should only have a reasonable expectation from the market. Don't have unreasonable expectations from the market. And equity is not going to create some magic in 2 or 3 years. These are long-term assets, right? So that's and therefore, the importance of starting early, the importance of making sure that when you have time on your hands, take a larger allocation to risk assets, right? I think that's those are all fundamental things that one must keep in mind.
Thanks a lot, Mr. Iyer, for the detailed explanations, which I'm sure will benefit our viewers immensely. My biggest takeaway from the conversation was that you should start planning and investing for retirement wherever you can and as early as you can. On that note, we come to the end of this conversation. Thanks a lot.
Insurance is the subject matter of the solicitation.